Malcolm, happy Thanksgiving week. How you doing?
I am good, man. I am a little sore, as I would expect. I just did the Philly half marathon over the weekend.
So last show I gave you credit for not just talking about marathons as soon as you didn't even wait. But I guess that's fair. I asked you how your weekend was, and you actually did a half marathon. That's fine. Okay,
that was
fast.
The highlight of my weekend.
Yeah, nice.
I spent the rest of the time watching the Cowboys beat Philly and resting my legs. So I mean, wait till I tell you about converting to veganism.
Oh, if I don't know if we can do a show together if you do that. If we start getting too far down the roll of what I'm eating, I should get everyone into creatine though. That might be a good idea. We can really shift the focus of this.
We're not going to start selling supplements. It's way too early in this show's existence for us to be selling Mega Man supplements.
Genuinely, congratulations on getting that half marathon done though. I know those things aren't easy, and I should actually maybe speak from the heart sometimes instead of just being callous and sarcastic.
It's fine. I was callous and sarcastic to myself all weekend because I was pissed off that I came in a minute and 1 second above my target.
Ooh.
Again. It keeps pissing me off, but
I think I'm getting some callous sarcasm. I've been on Zoom for about more than 30 hours from Wednesday through Saturday. So I've come off one day from that and I'm taking these classes. And I think that I know you've done these, you just kind of have to bite down on the mouthpiece and get through them. But I think that may up my callousness and sarcasticness a little bit. I think you're in more of these than me, but I haven't been in a class like this since college. And I am just, as a listener, let me know, but I am shocked by the number of people that are happy to interrupt a 200 to 300 person lecture with a question that may or may not make sense.
What does the clear button on the calculator do?
Or, hey, we're talking about how in a bankruptcy, in a Chapter 7 bankruptcy, you can discharge your assets in a 401k can't be touched in that bankruptcy, but in an IRA past a certain limit, those can be affected. And so someone's like, well, wait a second. If I'm in an IRA, then I have more investment options though. So let me just stop the train on this. And the lecturer has to explain, if someone's thinking about going bankrupt, they may not be worried about the flexibility of their investment options. And I have to watch this and yell at my screen on mute. So that's been all right, but I'm happy to be learning and improving. And that's the actual genuine response to that. Should we do the show? Any more?
Let's do the show.
Any more things you want to chat about? All right, let's get into it. So Malcolm, it feels to me like we're in a narrative shift on AI, where I think a few months, even a year ago, it was how are you invested in artificial intelligence to how are you protecting yourself when the bubble bursts? And I think that was especially true with this Nvidia quarter that happened last week, where Nvidia shoots the lights out. Their earnings are up 66%. They say we have $500 billion in revenue visibility, but traders, investors, they're not excited because of this narrative shift.
Yeah, I think that the thing that we have to point out is that the last 8 quarters, I want to say maybe 9 now, Nvidia showed up with an extra, quote unquote, extra $2 billion in revenue above and beyond what they guided for. And the market this time said, yeah, thanks, but ... That is absurd to me. There's companies out there that do $2 billion in lifetime sales over a 20-year span. And here you have a company that's saying, you remember when we told you 3 months ago that we were going to do $50 billion or whatever the number was? Yeah, we didn't actually mean that, even though you were excited about that number. We sprinkled in an extra couple bill and the market said, yeah, thanks, I'll take that. Now watch me sell these shares.
And if you're an analyst, I also don't understand why you wouldn't just increase your expectations by $2 billion every year, every quarter, if Nvidia does that consistently.
because they've raised the guidance. And so for people listening to this who don't actually understand or aren't familiar with earnings call parlance just yet, essentially the guidance that the CEO or the CFO of the company gives is what sets expectations for the upcoming quarter and potentially the rest of the fiscal year. And so each time they give guidance and says, we expect our revenues next quarter to be in a range between $48 and $50 billion, as an example. And as they get closer to time to turn in those numbers, they'll say we're guiding for the top end of that range or the bottom end of that range or the middle of that range. And instead, these guys said, we beat our expectations. We beat the guidance we gave you on the top end. And we also turned in an extra $2 billion of revenue, which for a company like Nvidia that's got like an 80% gross margin, $2 billion of extra money sprinkled on top is a lot of profit. So anyway, I find it fascinating that people have the audacity to say, I'm going to sell my shares now after this company just got done telling us they have $500 billion in expected earnings that they have to fulfill because of all the demand that has come in.
Yeah, I think the build out may not be done quite as quickly as the bears may expect. And it's something we've talked about. Yes, it could be a bubble that we're in. It's probably a bubble, but that doesn't mean you get to call the top. And you have two things happening with Nvidia that I think are interesting. One is the data center build out continues to benefit them tremendously. And they're saying this isn't stopping anytime soon. But we also saw some of that circular-ish deal making where Microsoft put $5 billion, Nvidia put $10 billion, 15 total if you're doing the math at home, into Anthropic. And specifically Microsoft on that was interesting to me, Malcolm, because they already have some open AI, it seems.
Mm-hmm. So Microsoft, Nvidia, investing in their next customer, their next future customer, makes perfect sense to me. If you consider Microsoft just reported earnings not that long ago, and they basically said our most profitable unit, Azure Cloud Services, grew revenues by 40% year over year from last year. And what that means is they're in a similar bucket as Nvidia, where they're now throwing off excess free cash flow because they're growing their profits faster than they can spend the money, believe it or not. And so they have to do something with this excess free cash flow. They can either give it back to investors in the form of a dividend. They can buy more shares out of the public markets to make the share price go up, because if there's fewer shares in circulation, then obviously, naturally, the share price has to go up, at least the day that they do the buyback. Or they can invest those dollars into something like R&D, where Nvidia is already spending a ton of money, tens of billions of dollars each year on R&D, and they still have all this excess free cash flow. And so it makes sense to me that these two companies specifically need to be investing in their next customer, their next partnership, their next whatever. A lot of the other companies that you want to talk about doing the circular deals, I'm there with you. The CoreWeave structure, for example, borrowing money to load up on chips to then turn around and lease the chips, hopefully for more than the debt service cost ends up being. That immediately gets shattered the moment that compute gets more efficient and we can't command as high a price anymore as we are today. I don't know how long that takes, but that's one of the first dominoes to fall. But for these two companies you mentioned specifically, that doesn't scare me nearly as much.
Yeah. And these are smaller investments compared to the actual size of the market cap for these. I appreciate the perspective on it. Anything else on Nvidia you want to hit? Because you sent me this article that I think you just send me things to rage bait me sometimes. And there's a writer in the Wall Street Journal. His name's Spencer Jacob. And he had an editorial that was titled in one newsletter, Why a Long Bear Market Wouldn't Be All Bad. And then was also titled, Why We Could Use a Good Long Bear Market. So I think there's some disagreement with the headline writers. But essentially, this gentleman is sort of rooting for a good long bear market, which to me had the vibe of like capital. It was like, listen, capital markets, you've been awfully naughty and you deserve a good spanking. And this is going to be healthy and good for you. But it also reminded me, like, there are people rooting for this. And it's something that myself, like, I'm younger. It's good to have a bear market from strictly an investing perspective. I've talked about why I have some more cash on the sidelines, but also I think there is a perspective from people in God mode economics, Malcolm, that is, I'm going to tell the market cycle what is good and healthy. When long bear markets, long recessions, these have devastating and sometimes permanent consequences for people and places. Like the 2008 recession, there's still impacts of that in Midwestern industrial towns. So you can't just say like, this is, there are therapeutic parts of this for these types of things.
Well, I think that we always have to parse out who are we specifically talking about when we say, quote unquote, a good thing. I think you have to keep in mind that we're referring specifically to the investor class of the United States, which is probably only about 50% of the country, which most people who do own stocks, they only own them inside their 401k or whatever their retirement plan is through their employer. They don't actually own these individual stocks that we talk about. So the market is made up of what we call institutional investors, giant fund managers, hedge funds, pension funds, those kinds of things. That's about 80% of the stock market. And then the other 20 is the people who are individuals who happen to own stocks. And that includes people like Jeff Bezos, Warren Buffett, Larry Ellison, like people who are just whales that own the majority of the stock of one company that's out there in rotation. And so we have to keep in mind that we're talking specifically about the 20% of retail investors who participate in the market, which is probably reflective of less than 50% of the US population. All that said, I'm going to take the risk of a lot of people turning off this podcast at this point and not listening to anything else I ever say.
Don't do that. Say you should keep listening because what I'm about to say is really interesting. There you go. Don't turn it off.
I will say to you, though, there is some validity to this argument. And what I'm specifically referring to is the expectations of retail investors have gotten so freaking out of whack. It drives me insane right now. Like I have people that will send me messages randomly and say like, hey, what's your next idea that's a 10 bagger that's going to 10x my money in the next 6 months? That's legitimately the kinds of messages that I get from strangers. And that is why I think we need a reset, right? Not necessarily a devastating stock market crash that just kills people's nest egg and tanks your net worth by 50%. But I do mean a slowdown to some degree that helps set expectations properly and makes people aware that stocks don't go up forever. They don't just go up and to the right. And also, the quality of the companies that you own matters more than just gambling and picking whatever happens to be the recommended flavor of the day from ChatGPT and buying 0-day options.
I mean, I think that some of the best investing decisions I ever made were in 2022 and early 2023 when that was when Meta was going for less than 20 times earnings. That's when you get opportunities to buy great companies at cheaper valuations.
Meta is one I should have held on to, by the way.
It's you can. I have a thought on that I want to get to later, but basically you can trick yourself into thinking like, should I treat my stocks as a liquid asset, even though they are, and playing that game too often, I think can be a mistake. Well,
Meta specifically, I don't want to own it long-term. I won't get into all the reasons why. It was a trade for me, but now looking at where I bought it and where I sold it, I'm like, man, I was right that the market was wrong to doubt Mark Zuckerberg and the metaverse and whatever else he decided to go shopping for. I was wrong about I should hurry up and get out of this thing before the other side of the trade comes for me.
I think you're right in that it is good and healthy for market cycles to exist in peaks, troughs, expansions, contractions. But I think sometimes you did a good job of addressing it. But I think sometimes when people in the investor class look at it, they don't give it with necessarily like they don't realize often that it is real people that are affected by this sometimes, even though it is an investing game we play. And I saw this, I guess he opened the piece. We'll see how interesting this is to people as people have already turned this off. Don't turn it off. But I get a little bit of an ick with this where he's talking about how In The Godfather, they talk about how you need a mob war basically once every 5 or 10 years to help get rid of the bad blood in the streets, and then going into why we need sort of an economic stock downturn. And Malcolm, when I see that from a Wall Street Journal editorial writer, did you ever see Prison Mike in The Office, where Michael Scott pretends that he has gone to prison and then is trying to tell like The Office lessons from life on the inside? I think we need, unless you're actually a gangster, let's not do lessons from the street as a Wall Street Journal opinion writer.
Well, I mean, there's a lot of scenes from The Office that probably apply to a lot of what's going on in the markets right now, especially the branch closing always coming for everybody and the layoffs always coming for everybody. And basically that's the bursting of this bubble that we keep throwing up there every Monday. We start the week with it, it feels like at this point. But anyway, I take your point that the mobster references don't necessarily have a place here, but it is an opinion piece. So I guess maybe that's where you're allowed to get a little loose with comparisons.
Let's get into some bubble talk, because I've been looking at some of the Aswath Damodaran stuff. And if you're not familiar with him, Aswath Damodaran is a finance valuation professor at New York University Stern School of Business. I
think they call him the Dean of Valuation, right? That's his tag.
He's the undisputed heavyweight champion of valuation, and I enjoy hearing what he has to say. One of the reasons I bought Meta back in 2022 was from listening to him. So I have a positive bias towards what he says, and he's been a little bit more bearish on where the market is right now. And I think there's some complexity to that, because it's getting a lot of attention right now based on some stuff he said on the Prof G show. However, he explained why he had sold half of his Nvidia position back in, I think it was March of this year, in a 55-page slide presentation subtitled ChatGPT made this. So that didn't quite get the attention, but I still think it's worth talking about, like looking at what he's writing about right now. Because as we've talked about bubbles on the show, we've talked about them from a negative context. But Damodaran is a contrarian, and as we welcome contrarian ideas on this show, he reminded us that bubbles are actually a good thing when I was looking through that 55-page presentation. So I'm going to run this take by you and get your response to it. He says, quote, "They changed the way we live and work. We would choose the chaos of bubbles and the change they create over a world run by actuaries, where we would still be living in caves, weighing the probabilities of whether fire is a good invention or not." If you want to check it out, the presentation is called AI, Winners, Losers, and Wannabes Beyond Buzzwords. And I enjoyed reading it. And it was also, to me, a good reminder that even though bubbles can be bad and devastating, there are very good things that come from it. And it is sort of integrated a function, not a bug, a feature, not a bug, of the economic system we live in.
Yeah, I think that's perfectly said. I think we enjoy a lot of innovation in America because of our willingness to set money on fire to see what works, right? Like, what makes the American capitalism machine so unique in comparison to other countries around the world is because we have such a bias toward risk. Now, there are tons of people and tons of companies that will get burnt up in that fire, but out from that fire comes a lot of wonderful things that we wouldn't have been able to even know that we wanted to waste our money on if someone hadn't been able to take that risk with that capital to be the 1 out of 100 in somebody's VC portfolio that turns into Uber, for example.
And what this means for you and me, and what I've started to look at, is this theory he has called the big market delusion. And it goes into what you're saying, which is you have VCs lighting off 100 little bottle rockets, hoping that one of them is not a dud and turns into a firework. And the way that this works fundamentally is that you have a big addressable market. So you have investors going into companies not based on the expectations of future cash flows necessarily, but look at the size of this big addressable market. Who are going to be the winners? And so VCs get in there and they get very excited and they start pumping money into the system. And then retail investors get excited and they start pumping money into the system. And then people realize that maybe the market isn't quite big enough to hold all of this investment. And then what happens is that there's sort of a bursting a little bit, and then a few firms emerge as the winners. Many fall, in the collective pricing, he says, will have to adjust to reality. I think this theory makes a lot of sense. And in this case with AI, it's kind of like you kind of already know what the winners are, in my view, or who has the best shot of being them. And it's, OpenAI, Nvidia, Amazon, maybe Google, Meta, if you want to throw those in. But it's one of those places where, as an investor, sometimes you don't have to get that creative.
See, I don't know about that. I think we have to consider that there are a ton of other companies that will come out of this investing cycle that we just can't see yet, right? So if you think about, we always talk about how Amazon was the really big winner of the 90s tech bubble, that once it burst and everything else went away, Amazon was left standing, even though its shares sold down like 80% or something from peak to trough, and then it had to work its way back. But there's about $300 billion, I think is the number, that was invested from VC firms and funds over the last 2 years. So since January of 2024 through the end of October, I believe is the stat. $300 billion have been invested into all these different AI startups. And most of those dollars so far have gone toward buying the cloud credits from Azure and AWS and Google Cloud just to get the products going. But all that to say, now that the infrastructure is built, the relationships have been formed, the tracks have been laid, there is opportunity for 2, 3, 10, 20, whatever AI startups to actually come through this investing cycle and actually show that there is some there. There's a company called Sierra AI, for example, that's run by one of the initial founders of Salesforce, Brett Taylor. He formed it 2 years ago, and they're already sitting on $100 million of annually recurring revenue as a startup. So they've got like a $10 billion valuation in 2 years, $100 million of annual recurring revenue. And that is an example of a company that has found that there is some there. They're building AI agents for all these different Fortune 500 companies that don't want to ever have to talk to their customers again. So like, that's a company that I expect that whenever it finally comes public, we'll have an opportunity to invest in something like that because of all of the super investment that's been made by Microsoft and Amazon and Nvidia and whoever else that we're questioning whether those dollars actually make sense being dumped into the ground.
Yeah, I think that point's well taken. There will be a lot of, I think, opportunities. Well, the question is if there's opportunities, the more niche you go with AI, or if those are also taken by companies like OpenAI. If you're a small, and this isn't what you're talking about with, we're going to build custom AI agents for you, which I think there is a big place for. And that's sort of that consultants who want a business model with AI. I feel like there's a place for that because there's always going to be people who need help building these agents and need help understanding. And there's also, the question for me is if there's a place for smaller companies where we're building AI specifically for lawyers. We're building AI specifically to help small to medium-sized businesses focused on veterinary care with their marketing issues. If there's a place for that, that's the question I have. Or if a lot of those, more niche applications are going to be completely subsumed by the big players like OpenAI. And the place I wanted to go with this by bringing up Aswath Damodaran is he got a lot of attention for his appearance on Prof G, saying there's no place to hide in stocks, basically, if things go awry. And his back of the napkin math is that AI spending needs to reach $3 to $4 trillion a year, for the build out to be worth it for the hyperscalers, the companies building the cloud compute capacity to really house these AI systems, companies like Microsoft and Amazon. And for those bets to be worth it, for the investment to be an NPV of $1, there needs to be $3 to $4 trillion per year in AI spending, not just spending on the infrastructure, which is what we're seeing now in the markets. And he has a lot of doubt that that's going to happen.
I will see your Aswath Damodaran analysis and raise you a JP Morgan analysis that's in a little bit more layman's terms, because you start talking about an NPV of +1, and I think you lose most people that have never sat through a college finance course.
Fair.
But so JP Morgan, similarly, they took a global view and said by 2030, these AI investments are going to reach about $5 trillion per annum, right? And They say in order to justify all that spend, these companies are going to need to create an additional $650 billion in annual revenues by that point for investors to see just a 10% return on that initial investment. Means absolutely nothing to you and me, right? Those numbers are so large that who cares? But the way they broke it down was that every single iPhone owner in the world would need to be willing to pay an additional $35 per month for AI enhanced products and subscriptions. So that's how
I like that context better. Yeah, 35 bucks a month per person.
Think about that though. So globally, right? So if you think about how many iPhone owners there are just in the United States, how many of those people are willing to pay for Apple's services that they currently charge for? Like, I don't have the Apple One or Apple Plus One or whatever it's called subscription. That's kind of like the holy grail to all the stuff on the platform, nor do I plan to pay for it. If it costs $10, I wouldn't pay for it, let alone $35. So if you consider that globally, where people have a lot less discretionary income than we do in America, that tells you how unrealistic it is to expect that number to be justified on a linear basis. So there has to be something that gets created using these technologies that we are actually willing to pay up for in a meaningful way, $35 per month for the subscription to make the spend worth it. They have to get creative enough with what that thing is or those things are to make us be willing to spend the money and not realize that we've spent it. Spotify as an example, Netflix, as an example. I can't tell you how much they charge me every month, but I can tell you it works every time I turn it on.
Or it'll be something like personalized medicine. If they can figure out like personalized medicine and personalized health in a way that is, really effective. And that's one of the promises of AI. What's that?
Do you think we really care about our health enough to spend an extra $35?
Do I think that they can charge an extra $35? Maybe. But if they're actually doing personalized medicine, that would be a dramatic breakthrough that impacts a lot of people.
I think it would impact about 600 people.
600. Okay.
Like however many people there are walking around right now with an Oura ring on,
yeah,
that's their total addressable market.
Wow.
Those are the people that are like fanatical about all of the biometrics that go into their human body. The rest of us people want to just eat our cheeseburgers in peace.
No, I'm saying that if AI can be used to create drugs that are curing a lot of diseases that we don't currently have cures for, and that was one of the promises of AI, then maybe you get to your $35 per month. And I said personalized medicine from not just the Oura ring component, but if you look at something like a cancer that is, changes dramatically based on the type of person where that disease lives, being able to develop medicine per person could be, we just saw Eli Lilly be the first $1 trillion medical company, right? Like there is a business in healthcare, and that to me, it seems like AI could be an answer for that, not just from the sense of, hey, you need to drink more water because your Oura ring told you to.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
All right, Malcolm, and this other story that I wanted to talk about was one you sent me about Schwab, or that Schwab reported about the trading activity on their platform. And every month they come out and say what people are buying and selling. And in October, it was Nvidia, Microsoft. That's what people liked. They were selling AMD and Apple. That's not the most interesting part, though. The most interesting part was when they broke it down by generation. And what they found is that Gen X, if you're born between 65 and 1980, you're the most aggressive when it comes to your investment risks. You have the most equity stocks in your portfolio, and the least aggressive, Gen Z. 1997 to 2012. And this was incredibly surprising to me, because everything you learn about, age and investment is that the younger that you are, the more risk you should be taking. And that's an investment truism that is effective in target date funds, the way people invest in their 401ks, any advice they get from a financial planner. Generally, the further you are from retirement, the more aggressive you need to be and ride out those investment cycles. And it's pretty much exactly the opposite we're seeing in this trading report.
So first let me set the stage. So this Schwab trading and investment report, the STAX report is what they call it. I forget what the acronym means sometimes, but basically it's their insight into what retail investors are buying and selling, right? So Schwab, the biggest retail investing platform by far, over $1 trillion or whatever in assets. They have an insight that no one else has on what retail investors are doing. And so what I think is fascinating about this is it proves the thing that I've been telling people for a while, which is that most people will classify themselves as a very aggressive investor, a conservative investor. I'm somewhere in between. I'm risk on, I'm risk off. We use all these different terms. But then when new clients come into the firm and we do an analysis on their portfolio and we have them do a risk profile assessment, and it says you're 40 from a risk preferred perspective. So 40 out of 100, you can imagine this is a pretty conservative minded investor. It's as far as them answering the questions in the questionnaire. Then we look at the profile. We look at their portfolio and it's invested as a 98 because all they own is Palantir and Tesla and Nvidia. And you're like, well, wait a minute. You just told me you don't like to take a lot of risk, but you own 3 of the most volatile stocks in the market, and that's your entire portfolio. And they're like, oh, well, I didn't think those were that risky because they keep going up. That is the disconnect that investors, this is the reason that people are saying we need to have a healthy downturn in the market to flush out some of the nonsense, because it helps reset people's expectations. This is the mindset sometimes of people coming in. So it doesn't surprise me all that much that I'm seeing Gen Z, who is the heaviest buyer of Vanguard's treasury fund, believe it or not.
Insane.
Because that's what's hot right now. Like buying gold and treasuries is what's hot right now for Gen Z, instead of just buying stocks in quality companies and holding on to them for dear life, like Gen X has learned to do because they got so banged up in the .com boom and bust very early on in their investing career. And then they turned around and got smacked again, just as they were feeling good about themselves as investors and homeowners and everything else during the Great Recession. Millennials, it makes sense that they would be a little bit more conservative with their investments, which we'll get into in a second and find out isn't necessarily the case. But it makes sense that millennials watching 08 happen to their parents would say, oh, heck no, I want to avoid all of the danger. In Gen Z, I don't understand the fascination with treasuries and with gold.
I think some of it is, economic trauma, from 2000 in Gen Z have no memory of 2008. Some do, but I think it's also a more sort of generational view on risk taking. If you look, the younger someone is, the less alcohol they're drinking, the fewer sexual partners they have. Just generally, they're taking fewer risks. And I think that is showing up in their investments as well. Is, I'm not taking that many risks with, socially, romantically. It makes sense that would fall into their investment approach as well. And I also understand, because I'm pretty close to Gen Z, but I also understand that it's sometimes tough to give a one single clean reason why an entire generation is making a broad investment decision.
Yeah, I am very far from Gen Z. I'm like smack dab in the middle of millennialhood, at least on my driver's license. Not really how I choose to live my life and carry myself, but technically I am smack in the middle of millennialhood. And so yes, I get your point that, you've seen all the dangers out there. And so you decide I'm going to go the opposite direction and be risk off. But the thing is, we complain, in the different headlines and the TikToks and the everything else, about how older generations have all the assets. They're in the way of us having prosperity and whatever else. One of the things that is, I don't know, I won't say unique to the boomer generation, but one of the things that has made them what they are collectively is their willingness to take risk. Now, some of that risk has been subsidized by the US government. So that's a whole other podcast episode, but their willingness to take risk is part of what has gotten them and this US stock market where it is. It's also part of the reason that I have such a hard time prying stocks from the hands of these boomers that are almost literally saying to me, yes, I hear your caution and I hear your conversation that you want to have with me about risk management, but you'll have to take these shares from my cold dead hand.
So when I was imagining someone coming to you with their, shares of Palantir, and I'm more of a risk off person, I was imagining someone who is in their, late 30s, maybe their 40s. And what it sounds like is these people are much closer to retirement. And they're like, nah, I should be in Palantir because it keeps going up and up and up. And that doesn't seem that risky to me.
Yeah, I think it's a mix of both. Okay. I think so. That's part of the issue that I'm talking about, though, is when I meet with someone who is 65 years old, they're preparing themselves mentally and financially for retirement. And they say, I would like to retire tomorrow morning. I don't want to take any risks in my portfolio whatsoever. Like, I'm a conservative investor. And then I start to do this deep dive into what they own. And I look and I go, what are you talking about? Like, you own the most risky stuff. Like, that's what got you here. Good for you. You had great timing and the market rewarded you for being willing to turn a blind eye, I guess. But here's what we should do going forward. And they're like, yeah, but I don't know if I want to sell my Palantir, though. And it's like, okay, well, just understand that we're not at a 40 like the math says you should be. We're not at a 50 or a 60. We're all the way out here at a 95. And so when this healthy reset that we're talking about does come for us, not if, but when it comes for us, just know that you're at the mercy of whatever Alex Karp decides to do based on what he had for breakfast that morning, or Elon Musk, or Jensen Huang, or whoever else runs some of these super volatile companies.
So what are younger people investing in? This is millennials, and this was very surprising to me. It's a lot of alternative investments. That's real estate and hedge funds. They now make up about 20% of millennials' investment portfolios on average. This is something that I'm not seeing, but this is something I don't understand. Why, why would someone need not just alternative investments, because a lot of this is private credit, and there's a big push for that in the investing world, which is, hey, we're going to take private debt from companies and chop it up and make it so regular retail investors can invest in this stuff. And it's actually something that I don't understand. Number one, the high percentage of this high percentage of alternative investments for younger people's retirement savings, and also this big push to private credit. Maybe those are two separate things, so I'll let you decide where to start.
Well, so when we say alternative investments, right, we're talking about things that are meant to be privately held, which means that the duration of the asset, the investment cycle, is supposed to be longer. So when I say that, what I mean is we're not buying super liquid things that can be traded on a daily basis, like shares of Palantir, to keep using that example. We're talking about things where you're investing for 5, 7, 10-year time horizons. And so the investments are given a much longer window before they have to actually pay off. And so if you think about, like I used the example on the show in the past, so I'll use it again. There's a private credit fund specifically that invests private dollars, you and me investing into this thing, that financed the rollout of clean energy EV buses for the Washington Metro Area Transit Authority. So all the buses driving around DC, Maryland, and Northern Virginia that have the clean energy stamp on the side of them were financed by individual people who were willing to invest in that refresh cycle. But what that means is if you invested $10, $50, $100,000 into that fund, it would be 7 to 10 years before they fully paid off that refresh cycle, because they've taken enough fares, they've taken enough trips all along the time that it took to refresh that bus cycle. Well, you know what happened in the middle of that? COVID. And you know what people weren't doing in the middle of that? Taking public transportation. So Did everyone who invested in that private credit fund actually receive all of their investment through that time period? I don't actually know, because I passed on the investment itself when I was looking at this deal that was presented to us as a firm to potentially put our clients' dollars into. So I'll have to look. Actually, I'm curious how it actually performed. But that's the kind of thing when we talk about private credit. There's an avocado factoring business where like you can invest dollars into a farm that produces avocados in California, like a lot of avocados in California. And they do it with private money. So they plant the seeds. It's like a 4-month cycle to turn over your dollars, return them to you with a little bit of juice, and then they come back to you basically a day later and say, hey, can you invest in our next crop? Well, you know what's not happening right now in California because ICE is out there taking people and putting them on buses? No one's actually harvesting the avocados. So if you invested in this private credit fund that focuses on factoring avocado farmers, you might be up the creek when it comes time to receive your next return. So all that to say, it can be a great investment, and it can pay off well. Some of these private investment funds that exist that are asking people to take these risks that are not in the public markets. But the difference is the time horizon is a lot longer. The risk that you don't see a return on that capital in some cases is a lot higher. It's the reason they're having to go to private investors and can't tap the public markets or go to a bank in the first place. And so you just have to have a level of skepticism, or at least the capacity to take this risk. And that, I think, is the disconnect. I think the reason that millennials are so willing to have 20% on average of their investment portfolio in these alternative investments is not necessarily because they perform so well. It's because they're trying to outsmart the market. They saw what happened in 08 and 09. They didn't like what happened to their parents. They said, that's not going to be me. I am smarter than everyone else. And so I am going to invest in these alternatives that are meant to be uncorrelated from the rest of the market.
So, a lot there. And we haven't talked about hedge funds. Hedge funds, I don't understand. Private credit, I still don't understand. Real estate, I kind of understand. That one, and that's because I own public REITs, which I don't think would be lumped in with these alternatives. But
no, it's the private real estate funds though that are lumped in with this.
I think public REITs make a lot of sense for people. But what I don't understand with private credit is for an average person, there's idiosyncratic risk, which you laid out, risk that can be, dependent on one thing going wrong. And for a regular person who's just saving for their own retirement and doesn't have a large trust foundation that is going to fund one day a presidential library or a museum, why do they need private credit? Why can't you get your debt appetite wet by just buying regular publicly traded bond funds?
Because nobody is positioning it to me as this is how we're going to outsmart the smart money. So what's happening right now, too, I'm glad that we're having this conversation because this is, if you can't tell, this is something that's been pissing me off for a couple of years now. Now, the advisors themselves, the advisor community, the space that I occupy as a professional who does this work on a daily basis, I'm getting pitched almost literally every single day in my inbox by some fund who is promising to outsmart the smart money on Wall Street by investing in some kind of fixed income fund that can deliver stock-like returns. Well, that just absolutely makes no sense, right? So I, as a person who am skeptical of just about everything and just about everybody, immediately go, yeah, no, I'm good. Like the last dude that was out there promising people consistent, double-digit returns and was actually delivering them for a while was Bernie Madoff. And there's a reason why he was able to deliver those kinds of returns on time, every time. And so anybody who's in my inbox promising me fixed income like safety, but stock like returns, there's something happening underneath the surface that I don't even need to look at to know that there's a scam going on somewhere. That's what's happening, though. All of these advisors are out there getting pitched and they're presenting it to their clients as, here's how we're going to be smarter than the smart money. So you should trust me with your life savings. And that's what's getting this stuff added in people's portfolios, not just the TikTokery that makes it look great and people say, I'm going to trust this stranger with my life savings, but also the people who are professional financial advisors who are supposed to be smarter than that, allocating on behalf of their clients into these funds that, for all intents and purposes, don't deliver any better returns than the public markets will at worst.
Well, I think we need to talk about incentives, right? Because why would people pitch this? One theory is that as investment fees have come down across public markets, ETFs, you can get ETFs for extraordinarily low costs. Where does Wall Street make their money? Where can you put in higher fee products? And it's with this private credit thing. So, the theory I have, or not that I have personally, that I could see with this is the reason these are being sold ultimately is because they can extract higher fees for these types of investments, even though they may not be the best for an average person saving for retirement.
Well, I think that's true, but I also think when I talk about the financial advisor community specifically, I think that part of the challenge is public markets, as we've been talking about since basically 2020, have been going up and to the right. And so clients are coming and saying, well, why do I really need you to help me manage my money when I've been doing great buying Palantir on my own? Like, I own Bitcoin. When you told me not to buy it back in 2020, when it was at like $18,000, $19,000 per token, I bought it and now I'm a multimillionaire. Why would I listen to you? So they're also trying to find ways to justify their investing prowess by saying, well, you can't get access to these private funds. Blue Owl's flagship private credit fund isn't available to you without me. And so you got to come through me if you want the good stuff. And that also is part of the positioning that's getting people into this crap.
The access economy. That makes a lot of sense. Anything else on this pissing you off before we start to wrap up?
There's plenty, but I'll save it for another show. Let's
end it there. If you like this show, if you've made it this far throughout the program, something you can really help us with, help the show grow. We're still new doing this thing. Number one, telling a friend that you think would benefit from listening to it or would enjoy it, please do that. And also just leaving a rating and a review wherever you listen, Apple Podcasts, Spotify. That helps tremendously. But I appreciate the time you've spent with us. If you have feedback on the show, if you want to talk to us more personally, not just pitch Malcolm on a private credit fund, you can email us at thistimepod@gmail.com. And if you want to follow us, Malcolm is at Malcolm on Money. I'm at Rick Sislick on X, Ricky Mulvey on LinkedIn, and we will see you next time.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.